All right, it's very surreal because I woke up this morning at 2:45 at Madison and 6th Avenue in New York, and then got to my flight to come here today. And they're like, you have 4 talks. I'm like, awesome. It's great to be in Dallas. I kind of grew up as a child of a Marine. I spent some time on the East Coast, Midwest, California. Ended up going to high school in Fort Worth, and then college at UT. Go Longhorns, Victoria. I noticed there was some. Okay, here's the clicker, right? I noticed that the first chinks in the armor in the stock market happened right here in Dallas, when the Dallas Mavericks made their trade. So that was kind of a big red flag of other trades to come. So what I like to look at is, I love some of the macro stuff and try to take a bigger overview of just kind of the underlying macro factors and not getting too granular, but then also combining that with technical tools just to kind of get a feel of. And the thing that I learned early on, and when I was in high school, my dad got me into trading options. Looking back, I think he was just trying to generate some commissions, but it stuck. And I've always been fascinated just by the idea of that the stock market kind of knows everything, and it's looking at things 6 months in advance. And from that, because a lot of times, people will ask like, well, gosh, how come the stock had good earnings and then it fell? Or in this case, but where the markets have the biggest moves is when there's something that just happens that it didn't price in. So you assume that the market has everything priced in, but then when you see some really crazy moves like we've had over the last 2 trading days, these are things that the market didn't take into account. And those I've always found have also produced the biggest opportunities, even though in the short term it looks a little crazy. So this is one of my favorite charts just in terms of getting a feel of what is the market doing right now, and is this a good time to invest or should we wait? So this is a 10-day moving average of what's called the combined index and equity put-call ratio. And the very simple way to look at this is that if it's down at the lower end of the range, that white line, that just means that there's an excess amount of bullish activity. There's record amount of people buying stocks. And if you think that if we're the only people on the planet right now, say everybody got wiped out by some contagion, and we're the only ones here, but luckily the stock market is still there and we get to trade. If all of us were long Apple in this room, what's Apple going to do next? It's going to fall because there's no one else left to buy it. And it takes a lot of energy to move a stock upward, but all that has to happen for it to fall is for people to stop buying. So this chart gives us kind of a roadmap of where people are in the spectrum. In addition, if you think of it, it's not just this room, it's people all over the world. And if we're down at the bottom of that range, it just means that there's excessive call activity, and it's just the market's a little too long. And when it gets to that level, it's hard for the market to go higher, and it oftentimes will pull back. So this is a snapshot of the markets 4 months ago. If we flash forward to today, you'll notice that the line has risen up to, it's about 0.85. And if you notice, if you go back and look at the last time it got it to 0.85, that's where we are now. When it gets to that point, that's when fear sets in and everybody's buying puts and oh my gosh, and all this stuff's happening to the downside, but people also get wrong on the downside as well when they start getting over emotional. And the last time we had a really solid bottom in there was when this level got to the exact same level that it closed at over this weekend. So when I see things like that, even though the move over the last 2 days has been kind of violent and exaggerated because it was something that the markets didn't price in, it presents this great opportunity when people get just they panic and get too nervous. Now on Monday, it's going to be interesting because we don't know yet if there's going to be any news that comes out over the weekend to kind of help offset that. But a lot of times what will happen after you get a Thursday and Friday like what we did, if you've got a lot of people out there using leverage, and which there are, what's going to happen on Monday? Because 3 days in, you start getting margin calls. So if we don't get any news that kind of gets the fears of the market a little bit in check, we could have something kind of like a margin call Monday, and those are typically the best days to buy. And I know it sounds scary, but you go back and look at any time you get something like that where there's forced selling. It's not selling based on fundamentals, it's selling based on people getting blown out of over-leveraged positions. It's your best entries, always, always, always. So if we do gap down on Monday, I had a standing good till cancel order on the SPY for the last year at 495, and this is in like longer term investments accounts. If I'm hoping that there is hoping is a strong word. Let's say if we gap down on Monday and I get a fill on that, I'll be glad. But the idea is that, look, the economy is not ending. This isn't going to cause business to slow down. NVIDIA is still selling a lot of chips. It's just that the valuations being accorded to these companies is changing for the short term, which gives us opportunities. It can be scary, but that's part of it. That's kind of the same thing, so we'll have to go over that. All right, so from a macro perspective, something that I've found that works pretty well, and this is there's this 18.5 to 19-year cycle in real estate that's been happening and documented in the United States for the last 250 years, give or take. I'm going to put this timer on to make sure I am on tracking here. So I met this guy who wrote this book called The Secret Life of Banking and Real Estate, which is the worst title I've ever heard for a book, but it's actually an interesting book. And I met him at the MoneyShow that Kim was putting on in London. Was it the Queen's 2? One of those? Yeah. QE2. And he was giving this talk in 2005, and he was talking about how in 2008 the real estate market was going to crash. And I'm like, yeah, whatever. And then, of course, 2008 happened, and I got really interested in his work. And according to the cycles that he's documented, and I've looked through a bunch of other stuff like this too, this is kind of the roadmap that I'm looking at. And so according to that, we would see another speculative phase in the market and in land prices going into 2026, possibly 2027. And then from there, actually a more serious potential correction, 2028, 2029, kind of similar to 2008. Now, does it mean it's going to happen exactly like that? No, but these cycles tend to repeat themselves. And if we see that in advance, it helps us plan. If there's pieces of real estate that you're holding as investments and want to sell, then over the next year or so is a good time to do that. You can probably buy it back in 5 years for a lot cheaper. If you're in your dream house, it doesn't matter, right? That's kind of so it's kind of getting our arms around what's important there. All right, so the main thing that's kind of driving a lot of this right now is you've got GDP and you've got debt to GDP. And if it gets too excessive, the Fed has to take action to kind of soak up the excess debts. They do that with all the balance sheet they do, all the balance sheet manipulations that they do. Some of the things that the biggest potential conflict that's coming up right now is interest rates. So if all this debt has to be refinanced at higher rates, and all of a sudden our interest rates go from $300 billion a year in taxpayer money to $1 trillion a year in taxpayer money at the rollover, that's going to cause a lot of problems. Why is Trump doing all these the tariff wars? It's driving down the US dollar, which is driving down interest rates, so it's going to make the debt cheaper. So that's part of what at least I think is happening in this, is that the economy and everybody wins if interest rates come back down, and what's the best way to get interest rates back down. And then once you get interest rates down, that also then starts lifting up all the asset prices and all the fun things. So that's kind of the bigger cycle thing. All right, great. But if we're looking at this from a trading perspective, because I like to look at this as, and when I say trading perspective, it's not day trading off of a 5-minute chart, but typically what I like to look at a stock is that about 80% of the time, it's trading in a range. And then about 20% of the time, it'll have kind of these spurts that create this greater than expected move. And so that's what I'm looking for. So I kept a couple of these charts in from the last time I did this talk about 4 months ago, just to kind of show you how these things kind of work out. So if you look at this chart where I circled, there's these red dots at the bottom. It's called a squeeze. And what this is just a relationship between the Bollinger Bands and the Keltner channels, and it's the volatility comes together and just compresses. It's building up energy, and then it has to release that energy, all right? And so in this case, it's like, all right, it's building up energy, and then it releases the energy, and this stock Meta has this kind of a great move. Now, if you'll notice at the very last bar of that chart, that histogram is light blue, light blue, light blue, and it turns dark blue. All right. Once, if you look at if you're watching the Olympics and someone races in the 200-meter dash, okay, they do the run, they're done, they're sweating, they're gasping for breath, they don't immediately go and run out of the race. They go sit down on the bench, get some electrolytes, stretch, rest, relax, and then they build up their energy for the next run. And that's exactly how stocks work as well. Investors get tired. They're not going to keep chasing the stock. So that first blue bar was the first sign that all this kind of energy being released from Meta was starting to come to an end. All right, so now we flash forward, and you can see that that marked the peak of the stock, and since then has started falling down, 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 down. Now, what I like about this is from a trading perspective, and I call it swing trading, so you're in positions for maybe a couple of weeks at a time. A couple of weeks, maybe a month or so, is that instead of, which is a lot different than buy and hold. I'm absolutely for buy and hold. I like an index fund. I like to dollar cost average. I don't try to time it. But on something like this, I'm absolutely looking to time it, and mostly using options. And so I'm looking for these buildups of energy, but more importantly, I'm looking for when these buildups of energy are done, because that's when you at least start the rollover. Okay, so the important thing here is that when a stock, there's a lot of things a stock won't do necessarily, but there's one thing it will always, always, always do, unless it's WorldCom or Enron, and that is revert back to its 21-period moving average. Okay, this is called a reversion to the mean. And when we look at something like this on a larger scale, let me see, is that the monthly chart? Yeah, that's a weekly chart. I'm just going to go here. Okay, so here's the S&P 500. S&P 500, we had this huge sell-off, right? Oh my gosh, there's all these, it's Thursday, Friday, down, down, down. All we're doing is reverting back to the 21-period moving average on a monthly chart. So it's important to understand that the longer we stay above that level, and once you start to turn momentum, this is the most repeatable pattern in the history of the stock market. You go back to the early 1900s, and it's the same thing, same thing, same thing. So from a trading perspective, we look at those opportunities as when it's running out of momentum for retests of these key moving averages, and that's a great time to get back in. Okay, yeah, now could it keep going a little bit further? Yes. But the two things from that is, one, it's a cautionary tale when it starts to do that. Okay, if this on a monthly chart is going to revert back to that moving average, what does that mean? In this case, the S&Ps have fallen almost 1,000 points. Is that something that you're willing to sit through? If you've got a long-term kind of an outlook, yeah, that's just part of the game. But if you are looking at more kind of timing and things like that, that's a good time to kind of step back out and then wait to reload. You can reload the same position again at those levels. So that's something I keep an eye on. Now, Monday, we could keep flushing lower. We don't know yet. But what I do know is that I'm in an area where I feel fine from a price perspective adding longer term positions. And if we look at the monthly chart of other stocks like NVIDIA and things like that, they're doing the exact same thing. On a daily chart, it looks like death just because we haven't seen something like this in a while. The last time we saw 2 back-to-back days as heavy as last Thursday and Friday was in March 2020. And back then we had a world pandemic, and so it made sense. This time it was like, okay, it seemed like to come out of left field a little bit. So this is the NASDAQ. So again, you can see here it is consolidating. This is 4 months ago. We start to lose momentum. That's the first sign that, okay, this move may be over and it's time to kind of revert back to the mean. And here we are looking at the monthly chart. So on the monthly chart here, same thing. You've got this loss of momentum. And at some point, like I said, there's few guarantees in life and in trading, but it's always guaranteed that a market will revert back to the mean. That includes when it overshoots to the downside as well. Again, unless it's Enron or WorldCom or Peloton. So this is something, when I look at something like this, the first thing is just to put everything that's happening in perspective. Because if you're watching CNBC during the day, it's red alert, everything's a disaster, all the news is bad. But underneath it all, this is in 2008, it really stuck out to me. In 2008, I kind of got the end of the world vibes. And my wife would make fun of me because I would have these bags of silver showing up from UPS. They're hauling them. And I thought, we got to get all our stuff together and stuff like that. And I remember on the worst day of the financial crisis, when it was the day when the money market funds were like minutes away from like showing negative returns and before they got funded, We went to the movies that night. It was packed. We went to Target to get some stuff. It was packed. People were out there living their lives. They're spending money. And we have to remember that just because our asset allocation might be down, it doesn't mean that there's a lot of human activity that's happening out there every day that generates a lot of sales for a lot of companies. No matter what's going on, everybody's going to need a beer and some toilet paper, right? And so we just got to understand where those opportunities are. All right, so what markets are doing well here? So something like gold here, this kind of ties in with the original macro picture that I was talking about. When we get to a point where the Fed, we're going to start seeing interest rates get lowered more aggressively, I think in 2026, and at some point the Fed may actually start kind of priming the pump a little bit. Gold is telling us that that's going to happen. Gold is saying, hey, you know what? I'm looking out into the future, a year from now, a year and a half from now, the dollar is going to start losing value. I'm that store of value. And the good news with all that is that does kind of prop up asset prices. I'm not saying it's smart. I'm not saying that at some point, but the whole point of, I was talking to my kids the other day, or my oldest son, and he's like, how are we going to pay back $35 trillion in debt? I'm like, we're not. It's never going to be paid back. It's just going to be monetized, meaning that as the dollar gets debased, it's a little bit cheaper to pay it off. That's just how the game works. This is the dollar. It's coming down hard. That's just simply good for the global economy. Interest rates starting to come down hard. That's going to be good for global economy, mortgages, things like that. This is Bitcoin. Bitcoin has proven very resilient during this whole thing. The nice thing about Bitcoin here, if you've never held it, it's now institutionalized. You can get ETFs that are actually holding Bitcoin. And I think it's a good allocation in this because it is something at this point that has proven to be stable. It's a digital store of value. And just remember, at any given time, we do not always have a perpetual markup in prices. It's accumulation, markup, distribution, markdown. The cycle starts all over again. We just went through distribution and a markdown. All right, boom. So if you guys want a copy of this or have any questions, that's my email, john@simplertrading.com. We also have kind of a trading room where we send out alerts on things like this too on there. Happy to share any of that information. And I think that's time. Yes? Okay. Thanks very much. Enjoy the rest of your night here together.